At the end of the day, it's the simplest way to think about it is you recognize the revenue when the services are being provided. So in a SaaS company, it's when based upon the contract, the term of the revenue should be recognized over the term of that license. And if you're selling additional seats or it's based upon some level of usage, make sure you're tracking that and you're tying that. Your revenue recognition should be tied to the contract and how the usage and delivery of the services are provided.
Are you a scaling SaaS founder? Ready to make the leap from leading a team to leading an organization? Join us each week as we refill your think tank with actionable tips and strategies from great business minds you know and those you don't know yet. This is SaaS Fuel with your host, 5-time entrepreneur, SaaS founder, and globetrotting adventurer, Jeff Maines.
Welcome back to the SaaS Fuel podcast, where book recommendations are less about what you should read and more about what you'll actually finish before getting distracted by, snacks and social media. I'm your host, Jeff Maines. I help B2B SaaS founders like you grow from traction to scale. Here, growth is more than just numbers. It's about crafting a future-proof company, premium valuation, and leaders who build a business of significance while living epic, adventurous lives. So what if the biggest risk to your company's future wasn't your competitors, your product, AI, or even your sales force, but the numbers hiding in plain sight in your financials? For SaaS founders, financial management isn't just about keeping the lights on, although it is that in some cases too. It's also about ensuring the entire machine runs smoothly, scales efficiently, and doesn't implode when market conditions shift. We've seen a lot of that over the past few years. Cash flow mismanagement, that is the silent killer of promising startups. Poor revenue recognition, oh man, say hello to compliance headaches. And let's not even start on the chaos that comes from a messy chart of accounts. Well, today we are cracking open the financial playbook that separates thriving SaaS companies from those that constantly scramble just to stay afloat. We're talking about the strategies that ensure you always have cash when you need it, the systems that prevent expensive mistakes, and why a fractional CFO might just be the secret weapon your business didn't know it needed. If you're tired of making financial decisions based on gut feelings and spreadsheets that make your head spin, this episode is exactly what you need. So, hey, let's break it down. Our founder on Tuesday was Alex Levin, co-founder and CEO of Regal.io, who took us inside the evolving world of AI-driven customer engagement. He broke down the power of voice AI, the benefits of blending AI with human agents, and how businesses can optimize customer journeys with automation. Really cool stuff. And our expert guest last week was Blair Bryant Nichols, who shared how SaaS founders can use storytelling, strategy, and authenticity to stand out, build connections, and grow their influence. His expertise is in building strategic speaking platforms, and he offered a fresh perspective on how founders can position themselves as thought leaders. Pretty cool, isn't it? Well, if you missed either of those episodes, go back and give them a listen. Lots of great stuff in there. My guest today is Dan DeGolier, founder of Ascent CFO Solutions. He is a seasoned financial leader dedicated to helping high-growth businesses master their finances and cash flow. Kind of important. With experience across multiple industries, including SaaS, e-commerce, and manufacturing, Dan has built a powerhouse team of fractional CFOs, finance executives, and accounting professionals. Through Ascent CFO Solutions, he helps businesses build it right the first time, ensuring financial stability and long-term success. Welcome, Mr. CFO, Dan DeGolier. Hey, Dan, welcome to SaaS Fuel.
Thanks so much for having me, Jeff. Excited to be here.
Excellent. Well, you started Ascent CFO Solutions all the way back in 2011. What was the market gap you saw then, and how has demand for fractional CFO services evolved over time?
Yeah, great. Thanks for the question. I sort of came across it, I don't want to say accidentally necessarily, but I came across the need for fractional CFO when I had taken a role as a full-time CFO for a company that really couldn't afford a full-time CFO, nor was it really a need for somebody to be in that seat 40 hours a week, all week long. So I think at that point in time, I thought it would be pretty interesting to be able to support multiple clients, multiple companies in their growth trajectory and provide some strategic CFO type support. But then since then, it's definitely evolved. We're definitely seeing it being adopted by more and more companies, not just tech companies or B2B
Sure.
SaaS companies, but we're seeing it across all kinds of industries where people realize that they can get a really qualified person on their team on a part-time basis and something they can afford.
I think really at every stage we need that financial strategy piece, but it's one of those things that's hard to know is when do we need somebody full time, and when do we really need somebody fractional, like you're saying, you were in a role and they didn't need you full time, and I think that's the case for a lot of companies. Let's say maybe 3 to 30 million. Where is it in there that, or why should they think about full time versus fractional?
I think people can get by with a fractional CFO longer than they think they can in a lot of
Yeah.
cases. I think that there's, when you reach a certain level of, it depends on your transaction volume and your transaction complexity. But, we see companies up to 20, 30, $40 million in revenue where if they've got a strong accounting team, if they've got maybe a full-time controller and a couple other accounting people on the team, maybe even an FP&A specialist, a 2 day a week CFO or 2.5, 3 day a week CFO can be a really good option for them. It's more affordable, and they still get somebody who's really engaged as part of their team. There tends to be an inflection point again where you've got a lot of if your transactions are very complex and they differ from one another, or if just the transaction volume is high enough that maybe you need better monitoring and better somebody who can be there 24/7, if you will.
Yeah.
But yeah, I would say definitely companies can get by a lot longer than they probably think they can with having a really qualified fractional CFO.
And for the audience, how do you segment the duties and responsibilities? What would be CFO type things versus controller or
Mhm.
accounting team? What are the key factors in
Sure.
deciding, I've got enough now that I really need somebody in that role?
Yeah, CFOs. The way I like to look at it is, as CFOs are looking forward, FP&A. They're taking the work of the controllers and the accountants of scorekeeping and having an accurate record of what has happened in the past, and then taking a strategic role to have forecast your cash flow, understand what your fundraising needs might be, whether it's debt or equity, and whatever form it might take. Having a clear strategy around the business, around pricing, around compensation, lots of different things that are strategic in nature is where the CFO plays. And again, that usually can only be done if there's a strong controller in place, a strong accounting team who is making sure you have really accurate historical numbers.
I like that. Well, one of the things we talked about when we first talked was having financial systems and building them right the first time.
Hmm.
And I think we probably, anybody that's built a company multiple times or multiple companies can really relate to that because I've done it wrong many times or not done it. So what
Right.
do you mean by building financial systems right the first time, and what are some of those mistakes?
Yeah, I think having a really good and clear chart of accounts so that you're tracking the right things in the right buckets, and you really have clarity on your gross margins and your margins by your product lines. Understanding the categories of your spend are really important. So I think that's the place to start, would be your chart of accounts, and making sure that the whole way that things are engineered and designed. And of course that chart of accounts is and the way those financials are classified also should be seamless with how you're forecasting. As you think about, you have a lot of discretion when it comes to marketing spend per se, but you don't necessarily have, with your fixed costs, you don't have a lot of discretion around what you can spend. So by putting it in those buckets, if you will, from a historical standpoint, and using those same categorizations for your forecasts are important.
Yeah. Any other big mistakes that you've seen, walking in and you go, oh my gosh, we've got to fix that immediately?
Oh, sure. I mean, you name it. That's a big part of it is how things are classified. And obviously, I'm going to always harp on cash flow, right? I think
Yeah,
that a big mistake companies make is like, oh, we're profitable. Well, based upon your payment terms and how quickly you're paying your vendors, things like that, you can still run out of cash even as a profitable company. So I
sure.
think just um, a unwavering focus on cash flows, both not historical but also forward looking cash flows. I think is one of the things that are most critical, and it's a mistake that a lot of especially first time founders might make. Um,
Yeah.
Kind of touching on a question you alluded to earlier, I find that people who tend to hire us earlier our founders are not first time founders. They're second and third
Yeah.
time founders, where they realize that that their first time around they decided to not focus on getting the books right and having accurate financial statements necessarily. And it's that second and third time founder realize, yeah, let's just do this right to begin with. We don't want to have to pay to then fix it later if we just go along with an approach that's sort of haphazard and sloppy.
Yeah. Yeah. Fixing it is painful and time consuming for sure.
Right, right, right.
Yeah. So I love that, building it right the first time. I mean, if that's something that somebody could take away from this episode, that's it.
Yeah,
Is get
yeah,
it right the first time. Don't put it off. Don't think that it's not going to cost you later, because it absolutely will.
100%.
Yeah. Yeah. So you mentioned cash flow, and that is absolutely a make or break kind of issue for any company, but especially SaaS. When we think about, what is our CAC payback time and things like that, what are some tips or frameworks for improving cash flow visibility and forecasting?
Well, I mean, if you're in a market in which your customers can pay you upfront for an annual contract rather than monthly, I mean that certainly can affect your ability to have better working capital and be able to defer when you need to raise your next round. If you're a venture backed firm who is raising multiple rounds of capital. Um, but really understanding what those payment terms are and making sure that you're following up. If you are, whether you're billing annually or quarterly or monthly, that you're collecting and following up and getting prepayments where you can. Just realize that cash is oxygen, and
Yeah.
so you need to keep that flowing. And then when it comes to cash outflows, try to negotiate the best terms you can for your vendor payments.
That makes a lot of sense. And I think that's a really good thing, is getting as much upfront as possible, but then also making sure that you're forecasting how that's being spent. Had a situation with a company that we were working with, and they were getting a lot up front, but their CAC payback time was about 8 months, and they were growing really
Mm,
fast.
yeah,
And so burning through that cash, and then they're looking forward, going, hey, we're not going to be able to pay our vendors and keep our system live in another,
right.
3, 4, 5, 6 months unless we do something.
Yeah, you've got to have real clarity around that. You need to understand, make sure your investors understand that as well. If you're
Yeah.
suddenly accelerating faster than you expected, but you do have a longer payback period, then it's important that you know where that capital is going to come from. If you need additional working capital, whether you're going to try to borrow or have from your investors or others. Where
Yeah.
that money is going to come from, and whether you're going to need to accelerate your timing of your next raise or the size of your next raise.
Yeah. Just because we collect it all up front doesn't mean we can spend it all up front.
Yeah, right, right.
Especially if sales slows down at some point. That's, a lot of companies really got caught, I think, in that, just
Hmm.
assuming that they were going to keep growing over the last couple of years, and then sales started
Yeah,
slowing. The sales cycle extended, sales started slowing down, and you really end up getting caught in some bad places if
you
you're not paying
absolutely have
attention to
to be
these.
prepared. You absolutely have to be prepared for a downside scenario as well. I mean, it's one thing
Yeah.
you can have your forecast that appears, that's been vetted and you feel like it's achievable based upon your pipeline and your go to market strategy and everything else. But if something does unforeseen happen and sales happen slower, understand what your plan B is. How are you going to, slow the hiring, or do you have to cut, are you going to have to cut costs? What does that look like if, especially if you just feel like the market forces and the winds have changed against you?
Yeah. A lot of founders do focus on cash flow positivity, and they think
Mhm.
about that, and some of them profitability.
Mhm.
But there's a big distinction between the two, and why is it that both of those matter and should be tracked differently?
Yeah, I mean, I would say the cash flow is more important to track because you can be profit like I mentioned earlier, you can be profitable, but still be cash flow negative based upon the gap financials will indicate what your gap profit is, but your cash flow is really what is going to provide your ability to continue as a going concern, and be able to continue to reinvest in the company and everything else. So they are different. It's I won't go into too much of accounting speak here, but essentially gap is you're recognizing costs when you incur them and recognizing revenue when it's sold and when the SaaS services are delivered. But that doesn't necessarily, those time periods don't always match up with when the cash is coming in the door or going out the door.
Yeah. Yeah. So let's talk a little bit about revenue recognition. I think that's a really important topic, and I've seen a lot of companies do it a lot of different ways, and some really smart, some very conservative, some not compliant with anything I've ever seen before. What do you see out there in the marketplace, and how should founders be thinking about revenue recognition?
At the end of the day, it's the simplest way to think about it is you recognize the revenue when the services are being provided. So in a SaaS company, it's when it's based upon the contract, the term of the revenue should be recognized over the term of that license. And if you're selling additional seats or it's based upon some level of usage, make sure you're tracking that, and you're tying that, your revenue recognition should be tied to the contract and how the usage and delivery of the services are provided.
So if you're selling something and you're collecting it all up front, you're recognizing it over time, not recognizing it all up front.
You're deferring that revenue over the period it's being delivered. And if you have a services component to it, then that again comes back to contract. You may need to amortize the implementation fee over the life of the contract as well. It depends on a number of factors there, and so I would, if you're going to be audited, make sure that you have somebody on your team, or talk to your audit firm about how to appropriately recognize that, because there are some intricacies there to be aware of.
Without a doubt. And it's interesting you mentioned like services or implementation, because it does matter.
Mm-hmm. Mm-hmm. And again, those are you have hard costs associated with that, right? You have
Right.
people costs of doing that, and maybe some licenses, some third-party licenses that you have involved there. So keep in mind that's how that's going to affect your working capital at the same time. Are you going to need to does that require an additional upfront payment from your customer in order to continue to scale that?
Yeah. Well, what metrics should founders be tracking, particularly from a financial perspective? And let's stick to, say, the $3 to $20 million range. What are the things that are most important?
I mean, it's the typical ones that probably most people are aware of. It's your MRR and your ARR and your CAC and your LTV. I really also am a big fan of the importance of net retention when you're at that size.
Yeah.
I think it's really critical to. I think an investor is going to care about that, and you as an executive team member ought to really be focused on net retention, and that of course is how much. Your current cohort is going to grow or shrink as a result of churn and upselling additional services within that cohort, whether it's
That
additional
fits right
seats,
into the contingency
additional
plans too.
add-ons. Yeah, true.
Yeah. Ascent CFO emphasizes robust dashboards and real-time visibility into metrics. So what role do financial dashboards play in decision making, and how do you guys see that, and recommend founders be looking at that on an ongoing basis?
Yeah, it's a great question. It's there's a reason it's called a dashboard, right? It's like driving a car. You've got to keep an eye on not just your how much gas you have in the tank, but whether your engine's overheating. I mean, there's a lot of things to know what's going on. So if you've established clear KPIs, which is the first step, what are your key KPIs for the given period, the month, the quarter, the year, the 3-year plan. Know what those KPIs are, and then be tracking those. And the nicest way to be able to do that is give a single screen of truth that gives you the current visibility as to whether you're on track or off track. Things like your pipeline, your sales pipeline. Are you realize what has to be top of funnel in order to hit your goals for the quarter? Is that on track or not? And have your dashboard is your kind of early warning system to show you if things are on track or if they're off track.
And is that something that you guys set up, or is that something that the founders should do on their own, or some combination?
We definitely what we typically do is we will work with the founders and the executive team to identify those KPIs. Let's really, every business is a little bit unique. What are the key drivers of your particular business? What's really gonna are going to be the key performance indicators that are going to be in advance of closing the books and recording the results. What are those going to look like? And then once that's developed, then we can build out. We've got a team here that we will work with clients with to create those dashboards. We'll use various tools, Power BI and others, to create a real time dashboard so people will have that real time visibility at all times.
No, that's good. Besides, net retention, net revenue retention, net dollar retention, what are some of the other ones that are really critical to pay attention to? I mean, MRR, ARR, you mentioned those.
Yep.
Net dollar retention for sure.
Even just pure churn is really important as well. Understanding if you're growing like crazy and your ARR is increasing, but you still have higher churn rates, you want to look at that and figure out what's going on, because that's going to be an important factor. The gross retention is also interesting. Your CAC to LTV, of course, is an important one to track. I mean, there's a number of them that are important, but I still think net retention when you're starting to scale is a super critical piece, because that's a tough hole to dig out of if you're going negative there or flat.
Yeah. Well, there's a pretty significant shift in probably a couple of years ago, and continued from growth at all cost to capital efficient growth. And it reminds me of the old Warren Buffett quote, only when the tide goes out do you discover who's been swimming naked. And when growth is just going crazy and you can do no wrong, there are
Right.
a lot of mistakes that can slide by. And
Yep.
now
Yep.
that we're in an era more of capital efficient growth, what are some of the best practices and things that we should be thinking about going forward?
Capital efficiency. That's the answer. It's a matter of understanding what is your growth at all. We tend to go through cycles, right? I've been around long enough to
Yeah.
see the cycles of growth at all cost versus make sure that you're being very efficient with the capital that you have on hand. Fundraising is taking longer. There's still a lot of capital on the sidelines, but things are taking longer. So best practices, I think, would be think hard about the people they're hiring and what they're adding to your team. I mean, as um, a technology company, people, at the end of the day, people are the most critical component. So do you have the right leadership with your customer success team to back to the churn issue? Are you spending your marketing and sales dollars wisely so that you're able to capture the ROI on those initiatives? Is the engineering team running as efficiently as possible? All those types of things, I think, are important. It's kind of, I don't want to make it sound too much like common sense, but it's like just understand the dollars you're spending. Are they the right place to be spending them and creating, moving towards your goals?
Yeah. Well, SaaS industry has historically prioritized growth over profitability. And, why is now the right time? I think it's probably always been the right time, but to really
Mhm.
shift our mindset toward balancing profitability and growth.
Yeah, there's a point in time. I mean, there's a in the early stages, it really is about market share and disruption. You're disrupting the way things have been done. Growth is probably the right way to look at things in the early stages. But there's a point in time when, and now that needs to pivot, and you've got right account. Capital isn't free forever. Capital doesn't just keep flowing in forever.
Right.
Eventually, a lot of companies are going to be looking for an exit, whether they're going to IPO or whether they're going to be acquired and with it by a strategic, where they can bring their technology into a larger company. But there's a point in time when you gotta meet your maker, I guess, and flip that switch and start to be cash flow neutral and cash flow positive,
Yeah.
and therefore profitable.
Right.
Again, there's
Right.
timing differences, but
Yeah. Yeah. Fundamentals actually do matter.
fundamentals matter 100%. 100%.
Amazing. Who knew?
Yeah.
But you've worked with
Love
companies
it.
scaling from startup to 100 million. What are
Uh-huh.
key financial milestones that SaaS leaders should focus on at each stage of that growth journey?
Wow. Okay, that's a big question.
It is.
I would, yeah, early on, it's MVP and making sure that you've got a market, understanding what your market looks like, and then there's the phase of sort of scaling the company where you're continuing to capture, continuing to grow and seeing growth in your ARR. Um, and then there's that point when you become more capital efficient. So there are, and a lot of this is dependent upon what your, uh, whether you're, what the funding environment is like out there, whether there's, what your goals are from the perspective of ramping sales, ramping, uh, what that exit strategy is. There's so many different inputs and outputs, and every company is a little bit different. But generally, yeah, it's in the early stages. You're proving you have something people want to buy. Then you're scaling it by going to off your market, whether you're going after SMBs or enterprises or a little bit of everything, and then reaching a point of maturity where you need to start moving towards a cash flow neutral, cash flow positive situation.
Ready to future proof your company and scale to new heights? Dive into the ultimate resource designed just for SaaS founders and C suite executives. Champion Leadership Group gives you an unfair advantage in scaling up revenue and outwitting competitors. Imagine solving your biggest scaling headaches and hitting 5, 10, 20 million ARR and beyond with ease. We take away the guesswork and the grunt work and replace it with framework by supporting you with our on demand fractional C suite team, a powerful operating system built into software, and a thriving community of fellow scaling SaaS founders. That's how we make it happen. If you're stuck at your current revenue level, this is your ticket out. Feel like your company is the world's best kept secret? We amplify your success. And hey, if you're already crushing it but too busy to breathe, we got your back. We'll free up 20% of your time in the first month. Now is the time to upgrade from traction to scale. If you're ready to work smarter and not just grind harder, schedule a 10-minute growth brainstorm. Completely free, not a sales call. You can't buy anything on there. And we will pinpoint the number one thing blocking revenue. Visit championleadership.com. That's where leaders evolve and companies transform. Well, thinking about fractional CFOs, we definitely want to have great people, and some of the best are increasingly in favor of flexible work arrangements where they're not in one company, they're in
Mhm.
multiple, which is good for them, but it's also good for the founders. Uh, how does your model attract top talent, and how do
Mm.
clients benefit from that approach?
Yeah. So the headline on our careers page is flexibility and variety. And I realize that there's a lot of people like myself who might get bored just working for one company day in and day out. And the idea of somebody who's been in the CFO chair before, they're an experienced CFO, they've raised capital, they're strong with FP&A, they're really great at building models, they're strategic in nature. There's a lot of benefits from being able to work across different industries and across different companies and with different teams. It can be really exciting. Now, it's not for everybody, right? Some people aren't necessarily wired that way. And so that's something we do when we're recruiting for talent, is to make sure people are really wired for um, not just being good at what they do, but being great communicators and really good at setting expectations and being able to switch. There's it's if you're working with three or four or five different companies, you've got to be able to be really good at time management and understand what it means to be able to switch from one mode to another as you're supporting different executive teams.
That makes a lot of sense.
You know,
What are maybe some myths or misconceptions that people would have about, fractional CFOs, and how do you address those?
hmm, myths or misperceptions. Um, that's a tough one. I'm not sure how to answer that.
Maybe a misconception is that, if I have somebody that's part-time or fractional, they're not really going to understand my business well enough to give me
Mm,
the advice that I need because I'm
sure,
super
sure,
special.
sure. Yeah, sure. I think that could be one where, and I think there probably are some fractional CFOs out there who do struggle with that. I think
Sure.
with us, we do. It is important. Our best engagements is where we really do engage as part of the executive team, right? Each CFO is working with between 3 to 5 clients generally, but a couple of those, maybe one or two of those, might be the more significant ones as far as the number of hours they're putting in. And so we want to go, and that'll change over time, right? We might start with an engagement where a client is especially cost sensitive. They're pretty early. We're probably not going to put in quite as many hours on a weekly and monthly basis with them. But those companies who are where we're really engaging deeply, we embed ourselves as part of that team. We're in the board meetings. We're in the executive offsite meetings. We're deeply embedded as part of that team. We're just doing that for a couple days a week rather than full time.
Sure. That makes a lot of sense. I think it's a really good model. And,
I like it.
finance doesn't change a lot from one company to another, especially if you're, within an industry. And I love having the expertise that you're able to take expertise that you gained at one organization or over
Mhm.
time and be able to
Yeah,
port that to another one. And
very
because
much
you've seen
so.
it so many times.
Very much so. And then also, as the team of our size, we're about 37, 38 people total right now. And we also leverage each other's collective experience. So if we
I
come
like
across a
that.
particular challenge and somebody has a question about whether it's integrating systems between one another, or whether it's uh, some other kind of a technical question that come across, we're able to communicate that within the team and bring in other resources to help them solve problems that maybe that teammates already seen before.
Well, you talked a little bit about mergers, acquisitions, and it could be sell side, buy side. When should companies be thinking about bringing in a full-time CFO or a fractional CFO, in advance of those types of decisions?
Yeah, I think it's really important to have a an expert on your team who's been through that before,
Yeah.
someone who's been around the block before. There's a lot of complexities when it comes to exiting a business. There's a lot of things that can go off the rails. Things probably will go off the rails at some point, and so you want to have somebody who's going to be steadfast and will allow help get things back on track. I don't without going into too much detail, right? There's motivation for buyers to try to renegotiate and bring the price down.
Yep.
Sellers don't want to see that happen. So anyway, there's a lot of complexity around that, and just having someone on the team who's been through it multiple times is really critical. Whether that's a fractional CFO or whether that's a another type of consultant or a full time CFO. M&A is a complex deal. You also need to have a great attorney who's been
Yep.
there, not a probably a general practitioner, if you will, but more of somebody who's done lots and lots of deals before. Having a good deal team is really important, whether you're using an investment banker or not. But having somebody on your team, fractional CFO or otherwise, I think is super critical.
Absolutely. Yeah, it's definitely not a job for the your bookkeeper, And
Correct.
you need this is the tax expert you need. It's not the person that does your tax return. It's somebody with deeper expertise in that, attorneys that deal with M&A. There's just so many ways, like you said, that things can go wrong, or things to look for. So you may feel really good in the deal and think, hey, this is great, and then you find out the valuation is half what it should be. There's so many things that can go sideways.
Yeah. Yeah. No, it's there's yeah. And you know, if you're going through it for the first time, you might totally freak out. But
Yes.
if you've got someone on the team who's done it 6 times, say, hey, this is normal, this is going to happen, and here's how we're going to get through it, and here's the strategy on this. It's kind of a chess match at times, so it's good to have a chess master, I guess, on your team.
Yeah. And that's a really good analogy for what it is, because it really is somebody that's kind of coordinating all of those parts and working along with the tax expert, the attorneys, the investors, the integration teams. Making sure that the market is right, the culture fits right. I mean, there's so much to think about, whether you're buying or selling.
Yep, 100%. You hit the nail on the head with that.
Yeah. I think one of the biggest mistakes that I've seen is waiting until the end. And it's like, hey, we're ready to go to market now. We're ready to raise. And now it's time to bring somebody in. And at that point, there's a little bit that can be done. But what really needs to happen is like 18 months, 2 years before, all of that stuff needs to be happening, getting up to that moment. Have you seen that as well?
Absolutely. There's a lot of prep work. You want to know, have expectations of what the data room is going to look like. Have all those pieces ready to go. So when it is time to go to market, you can populate your data room. I touched on it earlier, but having really crisp financials, accurate financials, accrual based that follow GAAP, and then having a reliable forecast process so that you're hitting your forecast numbers, because deals are going to take at least 90 days. So during that time, you're going to be closing the books 3 times. And if you say you're going to, if you're forecasting revenue and profit numbers during those 3 months, and then you're producing actuals, if you're missing those numbers, you're kind of screwed.
Right.
You've got to be able to, so you have to have that discipline of forecasting accurately, well in advance of that. And so you can hit those, hit or overachieve those numbers that you've shared with that buyer. Really, really important.
Yeah.
And there's
I think a lot of
and
founders are go ahead.
I was gonna say, as you touched on, but it's not a process where you just say, okay, I want to sell. We're recording this conversation in January. You don't want to say, okay, I'm getting ready. We want to sell in June. Like, no, you need to have minimum 18 months really to do it well, and to max and to get all of your pieces in order, so that you are ready to go to market with a coherent story and strategy, and have your team assembled. There's a lot of pieces that need to be in place in advance.
Yeah. I like that, story and strategy. Those are two key components, and they have to fit together.
100%. Yeah.
Yeah. I think a lot of founders are pretty good at forecasting, and maybe it's just gut feel the next 30, 60 days. But when they get to 90 or 180 or even a year, things are really, really fuzzy out there. What are ways that we can think about that, or things that we can do to make it more clear?
As far as your forecasting goes,
Yes.
yeah. I mean, experience helps. And understanding, the having somebody who can really vet your pipeline. I mean, a lot of it's going to, do you have a reliable forecast on your churn? You break down the revenue into multiple components. You've got your churn, your net retention, and how you're growing your existing cohort of clients, what are additional offerings you're going to have, and then how are you capturing your revenue? How reliable is that? And then you're, of course, on the expense side of your income statement, you also want to make sure you understand your COGS and your SG&A, and whether you're going to need to spend more to deliver more, and what that looks like from every single line item on your P&L. So I think It's just taking the time to understand and challenge and support all of your assumptions, and then learn every month. Every month you close the books, you realize, okay, what did we miss? What where are we on track? Are we off track in different categories? Is the marketing spend appropriate? Again, I'm coming back to that as being a highly discretionary area, where a lot of areas are less so.
Right, right. Well, the founders that do see acquisition as part of their exit strategy, what is the financial and operational groundwork they should be laying, 18 months in advance to maximize valuation and success?
Um, Clear metrics, clear KPIs, accurate gap financials, and again, back to the forecasts, having really dialed in line item accurate forecasts that it's like it's a little bit like training for a marathon or something, where you're learning, you're refining and improving, day after day, week after week, things you've learned about, your body if you're training, or your company if you're getting ready for an exit. It's just best practices to be super crisp on that.
Excellent. Where can people learn more about you and about Ascent CFO Solutions online?
Yeah, well, we're at ascentcfo.com, pretty easy to find. And then we're pretty active on LinkedIn. We don't really do much with other social media, but we try to be create, put some new pieces out there on our LinkedIn. So just search for Ascent CFO Solutions on LinkedIn. And we also have a newsletter, probably twice a quarter. We send out some content that we hope is valuable. We don't send emails for email's sake. We try to create things that are valuable. So feel free to sign up for our newsletter on our website as well.
Outstanding. We'll make sure and link all of that, including the newsletter subscription, in the show notes.
Wonderful.
So, Dan, it's a great conversation. Thanks for being on SaaS Fuel.
Yeah, thanks for having me, Jeff. It was really a fun time. I appreciate it.
Thanks again, Dan, for coming on the show and sharing your journey and insights. Such good stuff. You can learn more about Dan and Ascent CFO at ascentcfo.com. As always, all links, highlights, resources, and full show notes are available at saasfuel.com. And be sure to check us out on YouTube as well. Full video episodes, outtakes, shorts, reels. There's training out there, lots of stuff for you, and that's at Champion Leadership on YouTube. Thought leaders share. Share this episode with every SaaS founder whose entire cash flow strategy is, we'll raise another round before we run out of money. It's been tough the past couple of years to do that. Well, everyone who shares this week gets a limited edition SaaS CFO Magic 8 Ball. You shake it, and it only gives you one answer. Cut your burn rate, genius. What if your financial strategy could fuel sustainable SaaS growth instead of holding you back? Join us Thursday as Chris Ball, co-founder and managing partner at Hoxton Wealth, shares how he scaled his firm from $35 million to $2.1 billion under management. Discover key financial principles that drive long-term success and maybe a little bit of tax strategy as well. And on our founder episode next week, we'll sit down with Casper Torno, CEO and co-founder of QuestionBase, to explore how AI-powered Slack bots are revolutionizing knowledge management. Such cool stuff. Learn how to turn everyday team chats into actionable documentation that can streamline workflows and unlock team productivity. I will see you next time, and as always, enjoy the journey.
Thanks for listening to SaaS Fuel. Full show notes for each episode, which includes a summary, key takeaways, quotes, and any resources mentioned, are available at saasfuel.com. Be sure to follow and subscribe wherever you listen to podcasts. And if you're enjoying the content and getting value from these episodes, please leave us a rating and review at ratethispodcast.com/SaaSfuel. We'll be sure to read these out on future episodes.